So, Richard, are you finding that issue too with residential development competition a little further out, or not?
Well, if we look at Hawthorn, for instance, Mirvac acquired a site a number of years ago and were able to get a permit relatively quickly for about 18,000 square metres of office. Unfortunately, with the GFC, etc., that wasn't able to eventuate, and of course it was sold as a residential development site, as was another site in Camberwell Road in Camberwell, exactly the same scenario. We don't see that circumstance occur really in the outer suburban areas, though, Kevin.
Mm-hmm. Okay. So, Andrew, for the year ahead, if there were a few tips for clients of those attending this morning, what would they be?
I think first of all, the one thing that everyone should be doing is looking at deals through the bank's eyes. More so than ever at the moment, the banks are driving and shaping the market. So the more compelling your acquisition strategy, the better the debt package is going to be. So that's my first takeaway point, if you like. The second one, which is in a similar vein, is that for those with development sites here, I've never seen more value attached to a permit. And again, it's providing the certainty, the surety of the planning outcome, and again, it's helping on the banking and funding side of things. And finally, for the investors here, as we've said, we've harped on it, but it really is a point worth driving home. Rental reversion's where it's at. So when you're looking at an asset to acquire and you've got an impending vacancy or at lease expiry, don't be shied away. That's your opportunity. The glass is half full, and that's where you're going to capture your rent reversion.
Okay, Richard, any final tips for the year ahead?
Certainly, Kevin. Probably two tips. Landlords out there with a lease renewal perhaps coming up over the next year or so, I would strongly suggest you speak to your leasing agent, preferably a CB Richard Ellis leasing agent, and get them to drill down as to where your tenant can possibly move to. I touched on earlier how tight the marketplace is, and that's going to be the true I suppose, picture as to what you can do with your tenant with their lease renewal. There's certainly going to be a good opportunity to both increase the rental rate and also not having to give too much away as far as an incentive is concerned. The other point I'd like to make, there was another point I was going to make, and that was also in relation to speculative development. We've touched on that today as well. Developers out there with sites that perhaps are on a main road, near a freeway, close to good quality amenity. Now's the time to really consider going ahead with that development. We all understand that it's not an easy thing to do with funding at the moment, but I think the old adage, you build it and they will come, would certainly apply.
Okay, that's great. Some terrific ideas there. Please join me in thanking Richard and Andrew this morning.
Thank you, guys.
Thank you. Okay, we're going to switch our focus now to the industrial sector, and it's one that is showing some parallels to suburban office in some areas. So the driver, really the occupational driver of industrial that we keep a close eye on is imports, and it's certainly something we look at in our modelling and in our forecasting. And the container movements through any port is important in telling us obviously where imports are going, and I think this chart really tells the story of industrial better than any. One that's enjoyed steady, ongoing growth right through the last 17 years or so, up until 2009, when, of course, container traffic went backwards, and it's now started to pick up again. And I think that tells the story of the industrial sector. It has turned around and is starting to improve. In fact, the Port of Melbourne had a couple of record months last year of throughput as the trading volumes started to pick up again. But I think it really has starting to show that the construction activity is increasing. The pre-leasing has, the number of pre-leasing deals is improving, so the construction activity is turning around, and we do expect this year to deliver about 600,000 square metres. It's certainly a long way south of where the market was a few years ago, and it will take a couple of years for construction activity to move up again. But it is starting to happen, and it's starting to happen right around the key areas where you'd expect it. Certainly the retail sector seems to be very interested at the moment in improving its supply chain logistics to improve its operating performance. And this is where we're seeing the demand come from initially. On the investment market side, we've also seen a pickup in activity last year, but I think like suburban office and perhaps like all the sectors, The issue will be, where will the stock come from? We saw a particular, very rare, or I suppose a unique set of circumstances last year where the trusts were deciding to sell out of the industrial assets, and I think it was a once in sort of 20-year event last year that really drove the investment markets. So we'll be talking to our guys in a moment about where they think the stock will come from next year. In the pricing, just to focus on that for a moment, this really does, this chart really shows up that once in a 20-year trend where the trusts and the funds were net sellers, and it was a time when private investors and syndicates took the opportunity to get into the industrial market, into some of the higher quality stock that's been built and still exists on long leases in recent times. Owner-occupiers too were very active, getting in at a time when pricing was at a low point in the cycle and protecting their business interest for the next cycle, business cycle ahead. I guess the other thing that happened in industrial last year is we saw foreign investors stepping into the sector for the first time, buying portfolios, and that's perhaps something, a sign of the sophistication that now exists in the industrial sector, the strength of the covenants that underlie the asset class. The rental situation too was also quite different last year in industrial, and I think what's happened is that for the first time in 20 years we've seen some of the things that have been introduced into the industrial sector have effect. We've seen incentives, for example, increase over the downturn that we haven't seen happen before in the industrial market. So a bit like the office sector, the face rental's been held broadly steady, but the effective rental has reduced, and investors will be looking to benefit as the incentives come out of the market, just as they will in the office sector in the year ahead. Interestingly, when we look at the yield situation, of course, what really adds value to industrial and what has added value over the last cycle has been the movement in yield and riding the yield cycle, if you like. But we've really had almost one continuous cycle of tightening in the last 18 years, and so we're a bit uncertain how going forward the yield tightening will occur. Will it happen rapidly or will it happen slowly? If you look at certain phases, certain periods of yield tightening, in the first one there, in the early 90s, yields were compressing at a rate of 90 basis points per annum, quite high. And then by the next phase of yield tightening, early last decade, yields were tightening at about 45 basis points a year. And then in the last phase, they were tightening at about 40 basis points a year. So the higher they're coming down from, the quicker they fall, is the lesson there. Our forecasts assume a very mild compression, but indeed a definite compression from about 8.7, 8.6% at the moment. We assume a fairly gentle compression of about 25 basis points a year. And this is where the argument comes in. Some will tell you that activity in the market will push yields down much faster in the year ahead than what we're saying. We're being conservative because we think the cost of debt and that yield premium, the risk premium, can't afford to be squeezed too much too soon. But this is really where some of the debate is coming from, and I think our guys will have up in a moment will talk about this a bit more. But I mentioned before that once in a sort of a generation event occurred last year where the ownership patterns of industrial are starting to consolidate. And you can see where they've ended up, that a single owner now is head and shoulders above the ownership patterns of all the other major trusts and funds and private owners. And that of course, is Goodman. So we've got a sector now that's evolving to the point where it's almost similar in some ways to the retail sector, very high levels of ownership consolidation. But it may start to change the dynamic and the behaviour in this sector going forward. So let me summarise the outlook that we see it for the industrial market. The occupational drivers have certainly turned positive over the last 12 months, and it's starting to increase the pre-leasing activity. It's starting to move up gently toward the long-term averages of construction activity. We believe that the availability in industrial stock is actually quite low because, similar to suburban office, the construction activity shut down very quickly. And so it leaves us now in a situation of looking at pre-leasing or potentially even speculative development to fill the voids. Yields are compressing. We think that plus a return to some fairly mild rental growth in the industrial sector should be enough to see returns back up into the double digits this year. In fact, maybe even the low teens.